Money printing, or more precisely, the creation of money, has been a fundamental part of economic policy for centuries. Central banks and governments have relied on this powerful tool to stimulate economic growth, manage inflation, and stabilize financial systems. The basic idea is straightforward. By increasing the supply of money in the economy, demand rises, businesses ramp up production, and growth follows. But what has really happened to the concept of real money printing in today's rapidly changing world? Let's explore the journey and transformation of this essential economic mechanism. The story of money printing is one of constant evolution. In the earliest days, economies operated on barter systems, exchanging goods and services directly. As societies grew more complex, ancient currencies emerged. And eventually, precious metals like gold and silver became the backbone of economic exchange. Over time, the gold standard was established, tying the value of money to a specific amount of gold. This system provided stability but limited the flexibility of governments to respond to economic crises. As economies expanded and became more interconnected, the need for a more adaptable system led to the rise of fiat currency, which is money not backed by a physical commodity, but by the trust in the issuing government. The transition from the gold standard to fiat currency marked a significant turning point in the history of money creation. With fiat currency, central banks gained the ability to print money as needed, allowing for greater control over economic policy. This flexibility enabled governments to respond more effectively to economic downturns and financial crises. However, it also introduced new challenges, such as the risk of inflation and the temptation to overuse money printing as a quick fix for deeper economic problems. In recent years, the landscape of money creation has been transformed by the rise of digital transactions and cryptocurrencies. The advent of digital currencies has raised important questions about the future of traditional money printing. Some experts foresee a shift towards a more decentralized system of currency creation, where digital assets like Bitcoin challenge the authority of central banks. Others view this trend as a potential threat to the stability of the existing financial order. The relationship between digital currencies and traditional money printing is complex, with some arguing that digital currencies offer a new frontier for economic growth, while others see them as a destabilizing force in global markets. A defining moment in the modern history of money printing occurred during the 2008 financial crisis. In response to the collapse of financial markets, central banks around the world embarked on unprecedented money printing exercises, injecting trillions of dollars into their economies. The immediate result was a stabilization of financial markets and a boost to economic recovery. However, the long-term consequences, including rising debt levels and asset price inflation, have sparked intense debate among economists and policymakers about the true costs and benefits of such interventions. Today, the challenges surrounding real money printing are more complex than ever. Many argue that the current system has contributed to asset bubbles, wealth inequality, and economic instability. The line between stimulating the economy and inflating asset prices has become increasingly blurred. As the global economy becomes more digital, the traditional role of central banks in controlling inflation and stabilizing markets is being questioned. The debate continues. Does money printing offer a path to prosperity, or does it sow the seeds of future crises? As we look ahead, it is clear that the landscape of money creation is changing. Technological advancements and shifting economic paradigms are challenging the traditional methods of money printing. New policies and systems are emerging, and the future of money creation remains uncertain. Understanding the evolution of money printing and its effects on the economy is more important than ever. Share your thoughts in the comments and stay tuned for more deep dives into the world of economics.